Very good evening to everyone, and a warm welcome to all of you in today's webinar on portfolio and fixed income. I'm delighted to have a very senior CFP professional amongst us today, Mr. Joydeep Sen. And Joydeep and I, we have been working since long in the same industry and is a dear friend of ours. So Joydeep, thank you so much for, conducting today's webinar. And if you allow me a few minutes, I would be very happy and honored to, go through a brief profile of yours for all those who have maybe not fully aware. So allow me a minute to read. So friends, Joydeep Sen with us is a corporate trainer. He's also an author, and he's also a very, very prominent columnist. So he has been working in financial services industries for more than 25 years now. So of this, I think last 12, 13 years, he has been with BNP Paribas in the wealth management department as a senior vice president advisory desk. And prior to BNP, he has worked with different companies in the private sector also. And since 2017, Joydeep is on his own pursuing his passion. So he writes columns regularly in various financial publications. You would have also, I'm sure, gone through many of his columns, especially in Mint, Money Control, ET Wealth, ET Markets, Outlook Money, and so on and so forth. And as I told you earlier, he is also an author, and he has authored 4 books. Not one, not two, but 4 books. So if I may recall, one is on fixed income markets in India, investment opportunities for you. Then there is also one on mutual funds in India, vehicle for fixed income. So basically focusing on the fixed income, and that's how we thought that what none better candidate than Joydeep with us today to talk about this, a very important subject. He is also a visiting faculty with NISM in Patalganga, Mumbai, and also business schools like IMT Ghaziabad, SP Jain Global Mumbai. And he has been actively engaged in doing trainings for CRISIL, for CIEL, mutual funds, banks, and other NBFCs also. With NISM, he has also done a lot of content work in various papers and various subject matters and books and all. So Joydeep is an MBA from Jadavpur, Calcutta, and he has also been awarded 100 most influential BFSI leaders by the BFSI Congress in February 2019 and again in February 2023. So ladies and gentlemen, a round applause for Joydeep, and over to you, Joydeep, for today's session, today's webinar, which we are looking forward to. A warm welcome to you, Joydeep, and over to you.
Thank you, Alok. Thank you so much. And thank you for the opportunity for addressing the esteemed CFP professionals. So today's topic, you have already seen the caption, portfolio allocation and fixed income. So you as CFP professionals or CFP students, you are already aware what is allocation. But having said that, I would like to make a few points about allocation and speak to some extent about fixed income, and then go for the Q&A. So I will start my PPT. I will share the screen, and then we will do the Q&A. Yeah. So is my screen visible, Pritika?
Yes, very much.
Sir, it is. Yes, it is
Good.
visible.
Yeah. So this is the topic for the evening: asset allocation and fixed income, building resilient investment portfolios. So just some basics, building blocks about asset allocation. So this architecture of balance, what's the meaning of this thing? The structural mechanics of asset allocation and the foundational power of fixed income. So you will see this analogy here. I will show you. Equities are the sales and fixed income is the key. What is the reason for that? While equity does give you higher returns over a long period of time, over an adequate investment horizon, fixed income is more stable, which is why we are calling it the keel, and equity is the sales. So coming to this funda of allocation, so you have certain portfolio objectives, and within those portfolio objectives, you have certain pillars. So what are those pillars? Risk management, return optimization, and consistency. So risk management, so risk has multiple connotations, multiple aspects. We are talking about the volatility here measured by standard deviation. So different asset classes react differently to economic conditions. Just to give you a simple example, um, when GDP growth is high, when the economy is growing fast, equity does well because corporate earnings are better. But bonds do not do well because usually when the country is growing fast, economy is growing fast, inflation is higher. And when inflation is higher, the central bank of the country would increase interest rates, and yield level and price of bonds move inversely, usually. Or for example, when the economy is not doing well, the central bank of the country would cut interest rates, which is positive for bonds. But when the economy is not doing well, it is not positive for equities. As a ballpark, things may be different in the real world. Then return optimization. What is this thing? Seeking maximum returns for a given level of risk, aligning the portfolio with specific financial goals rather than chasing short-term trends. So these short-term trends, they were very much aware. At one point of time, we had crypto. At the peak, it was 1,20,000, 1,30,000 USD. Now it is like 65,000 USD per Bitcoin. Or even if I leave aside Bitcoin, we had a small cap rally sometime earlier. So chasing those short-term trends are non-optimal in the long run. You as a professional, you have to advise the right things to your client about risk management, which is volatility adjusted returns and return optimization. For a given level of risk, how can you optimize the returns for your client? And the headline which you see here, research consistently shows that asset allocation, not individual security selection, primary driver of the long-term performance and risk management. So what it means is people usually chase a particular stock or a particular fund. This stock is good, this fund is good, this stock is not good, this fund is not good, so I should sell it. While that is relevant, research shows that over a long period of time, you have so much in equity, so much in bonds, so much in gold, or other assets like, say, a silver or REITs or InvITs. That is a bigger driver of portfolio optimization than your ability or perceived ability to identify certain stocks or certain funds that will do well. So as an example, if equity is doing well, you invest in fund A or fund B, whichever fund is doing well or not doing well, it is relevant, but only so much. If equity is doing well, equity is doing well. When equity market is tanking, even if you can identify the right stock or the right fund, that does not make so much of a difference. As an example, if market has tanked 10%, a good stock or a good fund will tank, say, 7%. It will tank less, but still it is negative. So your portfolio allocation, like so much to equities, bonds, gold, silver, other assets, that is the bigger driver of portfolio optimization in the long term. And that is the essence of optimization. So you can see here, we will discuss more. We will discuss more about fixed income. So it encompasses government bonds, corporate bonds, money market instruments. Now, as I already said, fixed income is more stable. And why is it more stable? The underlying driver is that in equities, let us say there is a share with a face value of 10 rupees. The market price of the share can be anything, can be 100 rupees, can be 1,000 rupees. There's a company called MRF Limited. Face value is 10 rupees, market price is 1,40,000 rupees. It can be anything. Whereas in a bond, there is a defined maturity. I mean, apart from perpetual bonds, there is a defined maturity. So as an example, if the maturity is say 5 years from now, people know that after 5 years, I will get the face value back. As in, assuming it is the face value, people know. So as an example, if the face value is rupees 100, people know after 5 years, I will get back rupees 100 only. So the market price can be higher depending on the conditions, interest rates in the economy, central bank action, and all those things. Price can be 110, 120, 130, but it cannot be 500, it cannot be 1,000, because people know if it is 500,000 rupees today, after 5 years, I will get 100 rupees only. And there is a defined coupon. So what is coupon? It is interest only. Why it is called coupon is if you go back like 100 to 100 years, physical days, no computer, no internet. The interest was given by the issuer in the form of a paper coupon, a paper check. It was called a coupon. Holders, investors have to go to the office of the issuer, exchange that coupon, that physical check for the interest. And that is how interest is called coupon. So there is a coupon, fixed coupon defined like 7%, 8%, 9%. That will come to you every year, any which way on the defined date. And the market price can vary, like 100 rupees face value market price can be 90, 95, can be 110, 120. But unless the company is defaulting, market price will not be 10, market price will not be 1,000, which is why fixed income is more stable And to the extent you have debt in your portfolio, the performance of the portfolio will be more stable and you will receive better risk-adjusted returns. And another funda, so it is useful for financial planners, something called sequence of returns risk. What is this thing? In the retirement phase, let's say there's a person aged 60 years and he will live till say 80 years. So 20 years, and he has a corpus, he has his kitty invested, let's say mutual fund SWP, invested in mutual fund, and he or she has done an SWP, and he or she will get rupees so much every month. And he will sustain on that only for the next 20 years. And let's say for the sake of discussion, over the next 20 years, the average returns of both the portfolios are same. Now, again, to explain this concept, let us say in the first case, in the first 3 years, the portfolio is equity heavy, equity market tanks, and the person has to sell equities from the portfolio. And in the second case, the equity market is stable, equity market is upward sloping. Over the next few years, yes, it is not as much upward. So at the end of 20 years, the average return of both the portfolios are same. However, there is a big difference in the two portfolios. In the first case, since the equity market has tanked in the first 3 years, this person has to sell equities from his portfolio at a suboptimal level. So he is eating away that much more from his capital. So he has less capital deployed for the next 17 or 20 years. So ultimately, his portfolio does much worse than portfolio B. So what you see on screen is that towards my left, there's an orange component and there's a gray component. So the gray component is when the equity market is not doing well in the decumulation phase of your career. You have to sell, and ultimately you underperform big time. Whereas towards my right, scenario B, as you can see on screen, when you have this allocation, here orange is equity and the dark blue component is fixed income. You can sell or you can eat away from the fixed income component where the market is more stable. So ultimately, over the next 20 years, you will get a much better risk-adjusted returns. So that is about sequence of return risk in the retirement phase. Even though the average of two portfolios may be same, what is the sequence of this? Is it that it is high initially, little lower later, or is it low initially, a little higher later? And that makes a big difference, which is why in a retirement portfolio, decumulation portfolio, there should be some allocation to fixed income. You can see towards the bottom, it provides the necessary spending capital, entirely avoiding the need to liquidate equities at a distressed price. Some more funda. So contractual certainty. In equities, while there is a dividend, it is uncertain. There is no guarantee. There is no contractual certainty about dividend payments. And if you look at our payments, the dividend yield is the dividend paid by the company divided by the market price is only 1%, maybe 1.1 or 1.2%. The reason is market price is high. As an example, a company with a face value of 10 rupees, the company pays a dividend of 2 rupees. Payout ratio is 20%. But if the market price is 100 rupees, dividend yield is only 2%. If the market price is 200 rupees, dividend yield is only 1%. So in our market, in equity, dividend yield is only 1%. Whereas in bonds, there is a defined coupon, like 6%, 7%, 9%. That coupon is defined, and there's a defined date as well. Like payment, usually it is annual for corporate bonds, semi-annual for government bonds. Can be anything, can be monthly, can be quarterly, can be half-yearly, can be annual. So on the defined date, you get the defined cash flow into your bank account. So this certainty is there in fixed income. So some more scratching the surface, deep diving into fixed income. Investments that provide a regular return on your corpus, which we have already discussed. Rate of return or coupon is predefined, but mind you, your effective return from a bond is not the coupon, but it's the yield. There's a subtle difference. That subtle difference is, let's say there is a bond with a coupon rate of 7% and face value of 100 rupees, which means you will receive rupees 7 every year from that bond. Now, if you buy the bond at the face value of 100 rupees, your yield is 7%. However, if you pay a higher price, let's say 105 rupees or 110 rupees for the same 7 rupees coupon, your effective yield is little lower. And vice versa, if you pay 95 rupees for that same bond instead of 100 rupees for the same 7 rupees payment every year, your effective yield is higher than 7%. So that is yield, what we call YTM, or yield to maturity. Cash flow which you will get every year is the coupon. Yield is the effective return depending on your purchase price, higher than face value or lower than face value. So coupon payments continue as per the payout frequency. It is defined annual, monthly, quarterly, and at maturity. So the defined amount comes back. Usually it is the face value, unless it is a face value plus premium kind of thing. Mostly it is face value only. So whatever the with a face value, 100 rupees, 10 lakh rupees, that face value comes back to you on your maturity. So like I said earlier, why does bond prices not vary too much? Because people know on maturity, this much money will come back to me. Now coming to more about fixed income, while we as CFPs or CFP practicing or aspiring professionals, when we say fixed income, we'll talk of bonds only. Broadly, if you look at it, if you look at entire Bharat as against India, fixed income is wider, fixed income is broader. So bank deposit also is broadly part of fixed income. So bank deposit, EPF, PPF, these also are part of fixed income. So even though we do not perceive it as such, but it's fixed income only. So like in the overall portfolio, if a person has only so much in equity, but more in say fixed income or EPF or PPF, that means that invested is under allocated to equities. So to give you some perspective, I'll show you some numbers. This is the quantum of bank deposits in India, which is big. So 224 lakh crore is in FDs, 32 lakh crore in CASA, so 256 lakh crore. To give you a perspective, the GDP of the country is approximately 360 lakh crore. So approximately 360 lakh crore is the GDP of the country, and 256 lakh crore is the amount which is there in banks. So that is the potential. In case you were thinking of marketing, it could be fixed income mutual funds, it could be bonds. So this is the potential universe where people park in fixed income. Yeah. Now, some comparison similarities between FDs and bonds. FDs obviously have a fixed interest rate. Bonds also have a fixed interest rate, but there may be a subtle difference, as I said. If you are putting money, let's say in a 7% bank FD, your return is 7% period, no if, no but. Whereas in a bond, it is one is matter of your purchase price. Like I said earlier, 7% coupon bond, if face value is 100, if you are purchasing at 100 rupees, then your return is 7%. If you are paying higher, like 105 or 110, depending on the market conditions, your effective return is less than 7%. And if you are paying lower, like 95 or 90, your effective return is more than 7%. And also, if you are selling the bond premature, prior to maturity, as an example, there's a 5-year bond. You are selling after 3 years. Depending on the market condition, interest rates have gone up, interest rates have come down, bond prices have gone up or down. Depending on that, your return may be little higher or little lower. That subtle difference is there. Interest payment FDs, you know it, whatever frequency the bank commits to you. In bonds, it is also defined. It is mostly annual for corporate bonds, can be monthly, quarterly also. And there is a TDS of 10%. For bonds, it is 10,000 rupees for the interest quantum. And for bank FD, it is usually 50,000 rupees. It varies for senior citizens or other people. That broadly is the comparison. Now you see this, the next comparison. Liquidity between fixed deposits and bonds. So FDs are liquid. Everyone says it is liquid, yes. But there is a nuance here about the penalty. So one is a penalty. So the bank may say, if you withdraw prematurely, you may have to pay a penalty of 0.5% or 1%. Some banks may say that the penalty is wiped off. However, one point people miss out here is, if you withdraw prematurely, the bank will pay you only the commensurate interest and not the contracted interest. As an example, if you put a 5-year FD at a rate of say 7%, and they withdraw after 2 years, when you book the FD, if the 2-year rate was say 6.5%, you get only 6.5%. You won't get 7%, because in a way, I mean, don't mind my word, you are in a way deceiving the bank. You're told I'm booking a 5-year FD, but you are withdrawing after 2 years. So the bank won't pay you 7%. So we'll get 6.5%. On top of that, depending on the terms, you may have to pay a premature withdrawal penalty for FD liquidation. In bonds, it depends on the market condition. So the same example, 5-year bond, if you're selling after 2 years, if interest rates have gone up, yield levels have gone up, prices have come down, you get a little lower return. If interest rates have come down, bond prices have gone up, you get a little higher return. It is a function of the market at that point of time when you are selling. And liquidity also may be an issue. Mutual funds are highly liquid. In bonds, AAAs are highly liquid. But less than AAA, liquidity may be a question. So liquidity in the market is improving. We will discuss more about that, but that may be a question mark. Tenure is pretty clear. So FDs starting from 7 days to anything, 1 year, 2 years, 5 years, 10 years. In the bond market, if it is less than 1 year during issuance, it is money market. So bond market has to be more than 1 year maturity when issued. Afterwards, it is the residual maturity. Residual maturity means a 5-year bond issued 2 years ago is today a 3-year bond, not a 5-year bond. So a 5-year bond issued 4 year, 11 months earlier is today a 1 month paper in the secondary market. Regulation, bank FDs, RBI, corporate bonds, SEBI, listed bonds. Capital gains FDs are taxable at your marginal slab rate. So how the capital gain works in a bond is like this. Listed bond, if you hold for more than 1 year, the capital gain is taxable at 12.5%. However, it is the capital gain only. What it means is the coupon or interest is always taxable at your marginal slab rate, which is usually 30% plus surcharge and cess. Investment quantum, FDs, you know it. In a bond, so firstly, the face value becomes the minimum. As an example, if a bond is face value 10 lakh rupees, you have to invest at least 10 lakh rupees in that bond. If the face value is 100 rupees, yes, you can invest 100 rupees. If the face value is 10,000 rupees, you can invest 10,000 rupees. However, it also depends on the bond house because the bond house is giving you a service. So the bond house will stipulate certain conditions depending on the house or the business model or the particular bond. So the bond house may stipulate a minimum face value or transaction value for the transaction for investment in bonds. Bank FD safety, so you know it, up to 5 lakh rupees, there is a DICGC guarantee or DICGC insurance. In bonds, there is something called secured bonds. Secured bond means there's a charge against the assets, the lien against the assets of the company. But it depends. If the company is not safe, it depends. It's a court of law. So what we go by is the credit rating of the bond, the issuer's goodwill, the business model, the fundamentals, the research. That is what one should go by, and not so much by secured against assets or not secured against assets. So we discussed allocation earlier. So now we'll look more into why fixed income. This is just an example. So in this example, what I'm showing you is if we take the equity market latest peak, which happened in September 24. So FPIs started selling big time for October 24. So from October 24 till date, equity market has given approximately minus 9%, minus 10%, because FPI has been selling big time in equities. And from that point of time, if you were invested in GSEC, you would have got decent positive returns. Here is an example of a particular bond. You can see that name of the issuer, Muthoot FinCorp, 2030 maturity, coupon of 10.05%. Usually how it works is when inflation is coming down, when RBI is cutting interest rates in the market, yield levels are coming down, bond prices are moving up, you get a relatively higher return. Now, over the past some time, even though RBI cut rates, over the past 6 months, 1 year, interest rates, yield levels are actually going up in the market because of certain reasons. What we are showing you is that if you invested in equities on 27 September 24 till 1st of June, Nifty 50, you can see the blue bar here. Nifty 50 would have given you minus 10.6%. Mid cap would have given you plus 0.74. Small cap would have given you minus 6.5. 500 would have given you minus 8.3. To put it simply, equity would have given you negative returns. In this bond, you would have got a higher return. Now, how is this higher return? The coupon is 10.05%, but the return shown here is 11.08%, which is higher than 10.05. So how does it work? Even when yield levels in the market is moving up, if the company is doing well, and if there's a credit rating upgrade, yield levels come down. Yield and price move inversely. So driven by a credit rating upgrade, yield levels will come down for the particular bond. So you would have got plus 11.08% return. So what is the point I'm making? The point I'm making is what I've started from allocation. If you are bullish in equities, good. I also believe in the India growth story. But if you are in a 100% equity portfolio, from September 24 till date, if you invested in September 24, you would be sitting on negative returns. To the extent you have fixed income in the portfolio, overall portfolio performance would have been that much better. So there's an example what you see on screen. One is a 100% equity portfolio and one is a 60-40 portfolio, 60 equity, 40 debt. Now, assuming there's something happening like COVID or something, Drawdown means fall from the peak, the latest peak. So a 100% equity portfolio, if the drawdown is 45%, your value would have been 55. Assuming you invested at the peak, your portfolio value as of today would have been 55. If you had a 60-40 balanced portfolio, that 40% will give you the cushion, and 60% would have fallen this much, 45%. So your portfolio would have been down 25%. So net, if you invested at the peak and there's a 45% fall in the market in a 100% equity portfolio, your portfolio value today would be 55 rupees. In a 60-40 portfolio, your portfolio value today would be 75 rupees, which is 25% down from the peak. That is the essence of allocation. Now diving more.
Joydeep, so sorry to interrupt you. If you can please go back to the previous slide for a moment, please. Yeah, so here when you speak about time, so how big is this time? Is this performance what you are showing 60-40 balanced and 100% equity? So is there any referral of time here? Are we talking in months? Are we talking in years when we speak about time?
Not in this graph. So I will tell you verbally. There are multiple examples. As an example, from January 2020 to 23rd March 2020, pre-COVID, it was a matter of 3 months. In a matter of 3 months, index was minus 38%. Index means Nifty or Sensex. Index was minus 38%. Over the next 1 year or so, index went up 100%. Now, in the current context, like we are discussing, like you can see here, 27 September 24 was the latest peak. And now we're into June 26. So it all depends. So what I'm showing you here is the example, irrespective of so time. There are so many examples. The current phase, correction phase, has been little long drawn because of FPI selling from September 24 till date.
Understood.
Yeah. So the arguments for fixed income we can see are capital preservation. So like we have said, unless the bond defaults, there is a known maturity price and there's a known coupon or interest. Stable income because the coupon is there. Diversification we have discussed. Managing sequence risk we have discussed. In the retirement phase, those 20-25 years, in what sequence is equity market performing? Even though average may be same, is it high initially, low later, or low initially, high later? And tactical flexibility means if you want to invest more into equity and there's a market correction, if you have some allocation to fixed income, you can quickly move from this fixed income allocation to equities. So equity investment, of course, should be there. I also believe in the India growth story. So it all depends. As an example, if you have, let's say, 60-30-10 portfolio, 60 equity, 30 bonds, 10 gold. Because of a market correction, let's say equity falls to 50 because there's a market correction. You will rebalance, you will buy some equity, and you will be buying some equity at a low price, so buying low and selling high. So we'll be selling some fixed income and buying some equity, and vice versa. If there's a rally in the market, 60 becomes 70 or 80. You will rebalance your portfolio, which means you will be selling equity at a higher price, so you'll be booking profits. So that is about flexibility or portfolio balancing. Different objectives of investors. In the initial phase, when you were 20, 25, 30-year-old, it is about savings and investments. It is more about stability. Then mid-career. So in the pre-retiree phase, it is like approximately 55 years of age. So it is called the consolidation phase. So in the consolidation phase, when you are moving to what is called decumulation phase, you have to gradually reduce the risky asset, that is equity, and you have to gradually increase the stable asset, which is fixed income. And then, of course, in the retired phase, as you know, there should be a higher allocation to fixed income because stability is the bigger thing there than returns. So return maximization or return optimization is an objective, which is more so like mid-career or that kind of stage. But pre-retiree or retiree kind of stage, it is more about stability than return maximization. Okay, now coming to certain aspects, risks of fixed income. Having said that, fixed income is not risk-free. There are certain risks within fixed income itself. So one is the market price movements. The first point you see here, interest rate risk. So interest rate risk means, so interest rate or yield and price move inversely. If interest rate or yield moves up, price comes down. That is a risk. So as an example, if inflation is high, the central bank of the country is increasing or expected to increase interest rates, bond yields move up, bond prices come down, and vice versa. Interest rates coming down, bond prices move up. So the risk here is if interest rates move up. Reinvestment risk is there's a defined coupon. Let's say there's a 8% coupon. 8% coupons comes to you every year. Meanwhile, if the interest rate structure in the economy has come down, then you are reinvesting that coupon at a rate lower than 8%, maybe 7 or 6%, which means your overall returns are lower than you initially thought. Or for example, the bond matures and you reinvest the entire proceeds in another bond of yield less than 8%. Again, it is suboptimal. Inflation risk, you know it. Your returns are net of inflation. And default risk is there. But the good part is, I will tell you more about that. Now the situation is much better. So if you recall the earlier default cycle, there was this ILFS default which happened in September 18, the DHFL happened in 19, multiple others in 2019. Yes Bank happened in first week of March 2020. But from those days till now, the corporate health scenario is much better and bank NPA scenario is much better. So we're in a much better position now. But yes, default risk is one of the risks in bonds. Now some flavor about the market. Outstanding quantum of bonds, corporate bonds is approximately 60 lakh crore. Quantum of GSEC is approximately 110, 120 lakh crore. Corporate bond approximately 60 lakh crore. And there is something called SGS, State Government Security, also called SDL, that is State Development Loan. So SGS or SDL is approximately 60 lakh crore. Government bonds around 110, 120 lakh crore. And corporate bonds approximately 60 lakh crore. That is the broad profile of the market. And last year, FY26, about 10 lakh crore was the quantum of primary issuance in the primary corporate bond market. Now, what I just alluded to, corporate health is much better than earlier. So in that phase, like 2017 or thereabouts, banking sector NPA, gross means before provisioning. Gross NPA was like approximately, it was in double digits. And net NPA was like 5-6%. Since those days till now, banks have done recoveries, banks have done write-offs. Today, bank NPA gross is like 2-point-something%, and net bank NPA after provisioning is less than 1%, very significantly less than 1%. So significant improvement has happened on that health of that bank loans. What I'm showing you here is credit agencies like CRISIL, ICRA Care, there is something called credit ratio. Credit ratio means in a given time period, like 6 months or 1 year, how many companies the agency has upgraded and how many companies the agency has downgraded. As an example, over a 6-month period, if the agency like CRISIL or ICRA Care, they upgrade 200 companies and downgrade 100 companies, then the ratio is 2. That means they have upgraded double the number of companies than they have downgraded. So any credit ratio of more than 1 is positive because it shows they have upgraded more companies than they have downgraded. So somebody show it as credit ratio, somebody show it as upgrade downgrade ratio. So in a way, they are similar. So you can see on screen multiple agencies, CRISIL, ICRA Care. For quite some time, this ratio has been not only more than 1, but significantly more than 1. And the other significant thing here is, you know what? So usually when the economy is not doing well, you would expect bond defaults to go up. In the COVID phase, FY21, our GDP growth was minus 5.8%. Our GDP decreased. However, during the COVID phase, we did not hear of any fresh major default breaking out. Whatever defaults happened, it was before COVID because of some other reason. During COVID, when the economy decreased, we did not hear of any fresh major default breakout. After COVID, FY22 onwards, you can see on screen towards my left, the ICRA thing, that blue bar, it is 3. What it means is just after COVID, when the economy is just recovering from the COVID challenge, since then, this credit ratio or upgrade downgrade ratio has been significantly higher. So what it means is today corporate health is much better than earlier. I don't have it here, but otherwise, if you look at metrics like interest coverage ratio, EBITDA, and all those things, corporate, these are much better than earlier. So that's about corporate health. So why push for bonds or fixed income? You can see some data, certain arguments, certain rationale here. SEBI has given the data in retail equity derivatives F&O. 93% of retail investors lose money, and that is year after year, and that is even after SEBI warning. So policy intent, so retail capital should be long-term and stable. So equity investment is good, but equity investment is good, not equity trading. In trading, it's a high risk. You may lose your entire capital also. You may lose your short also. So policy intent is there. Retail capital should be long-term and stable. Bonds, structurally safer. We have already discussed that. Capital market deepening. So the government, the regulators, they are taking multiple efforts to deepen the capital market. And ease of access. So if you look at it traditionally, conventionally, bond market has not been very accessible. It is morely, even today, it is largely institution oriented. Institution means the big boss of the market: banks, insurance companies, mutual funds, large corporate treasuries, sovereign funds, and all these things. However, things are improving. So like RBI, Reserve Bank of India, they have started something called Retail Direct Gilt, RDG, where you can simply open an account and you can purchase government securities, you can purchase SGS, which is state government security, you can purchase T-bills, sovereign gold bonds, all these things you can purchase even without a demat account. So the RBI, the central bank of the country, is doing it for you. On bonds, corporate bonds, there is something called OBPP, that is online bond provider platforms. So today's age, online, digital, these platforms are there and you can transact with them and you can invest in bonds, which is on offer on their website. So with these things and spread of awareness, spread of internet and awareness, retail participation is increasing. So that is the good part. So a little bit of this thing about the types or categories of bonds. There are government bonds, high safety, no default risk. Yield is relatively lower because there is no default risk, the safest bonds. The yield is relatively lower. Then we have corporate bonds. In corporate bonds, yield is relatively higher. Again, it's a definition of that that hierarchy: AAA, AA, single A. So from GSEC to AAA, yield is higher. From AAA to AA, yield is even higher. AA to single A, yield is even higher. And this also is a function of the perception of the market. Credit rating is only one of the things. So the agency may have given AAA or AA or single A to that particular issuer, but the market perceives every issuer in a certain way as per the research done by the big boys like all these banks, insurance, mutual funds. They do research and the market has a certain perception. High yield is like, say, single A or triple B kind of bonds, where the yield is even higher and you get even higher returns. Okay. So some funda about the types of bonds. In government, there is the central government, and there are states. So central governments, GSECs, government bonds. States, they issue SGS or STL, state government security or state development loan. The central government issues the what is called dated, so more than 1 year maturity, like 1 year, 5 year, 10 year, 40 year GSECs. T-bills less than 1 year. SGS multiple maturity, 3 years, 10 years, 15 years. PSUs issue mostly taxable bonds. Mind you, PSU bonds also trade in the corporate bond segment, not in the government segment. And banks issue multiple types of bonds. Additional tier 1 bonds, the usual bonds are issued by banks. This we have already discussed. Central government, GSECs and T-bills, state SGS or SDL. Corporate bonds, you can see some logos on screen. So there are multiple issuers, both PSUs and private sector. So tax-free bonds, there is no fresh issuance over the last 9 years or so. Whatever was issued earlier, those are there in the market, in the secondary market. Certain notified zero coupon bonds. So here in the notified zero coupon bonds, the difference between the issue price and the maturity price is treated as capital gains for the purpose of taxation. Otherwise, in a zero coupon bond, that differential is taxable as interest at your marginal slab rate. So most PSU or corporate bonds are a taxable variety. Bank, we have already discussed. You can see some logos on screen. So corporates, just to, as we touched earlier, secured and unsecured. Secured means charge against assets of the company. However, it is more about the goodwill or standing of the company. It's like if it is a very blue chip AAA issuer, even if it is an unsecured bond, that is safer than, let's say, a single A or a triple B issuer secured bond, because the triple B issuer, they will have a legal charge lien against the assets of the company, which is legally valid, no issues on that. But if the company defaults, you're in bad shape. You have to go to the court of law and all those things are there. So it is more about the perception, the research, the credit rating and research about the company, how good the company is. That's about the safety. Now some comparative about the investment methods. You can buy bonds yourself. You can go through a PMS, which is portfolio management service, or you can go through debt mutual funds. This is the comparison. When you are buying bonds yourself or doing it through a PMS, it's a wide range, double A, single A, triple A. Whereas in a debt mutual fund, so mutual fund being for the masses, usually it is good quality portfolios. And there's a particular fund category called credit risk fund, which is they maintain at double A or single A orientation kind of thing. Return visibility, there's something called hold till maturity. So what it means is, let us say buy a 5-year bond at a yield of say 8%. After 3 years in the market, interest rates may have gone up, price may have come down. However, you will book a loss as in you will sell suboptimal only if you sell. If you don't do anything, if you simply hold till maturity, you will get 8% return. So HTM means that today in the market, if interest rates have gone up, prices have come down, if you sell, it will be suboptimal. If you don't do anything, if you simply hold till maturity, you will be getting your contractual returns. In a debt mutual fund, how it works is you have to hold till the adequate maturity horizon. So if you hold till the adequate maturity, as an example, if it is a 3-year portfolio maturity fund, if you hold till 3 years, or if it's a 10-year portfolio maturity fund, you hold for 10 years. Usually how it works is there's a coupon, that coupon gives a cushion and market cycles are taken care of. So you usually get proper risk adjusted returns provided to hold for the adequate horizon. Quality depends. Direct bonds PMS usually will not do AAA because of the yield thing. Double A, single A is the focus area. Debt mutual funds usually do good quality AAA oriented portfolios. Credit risk fund, medium duration funds, they will do a little bit of credit calls like single A and double A for the yield enhancement. Diversification, when you buy a mutual fund unit, you are already buying a diversified portfolio. Whereas in a direct bond or PMS is a diversified portfolio, they'll give it to you. If you are buying bonds yourself, it is up to you that you buy multiple bonds and don't over concentrate on one particular bond. Don't over allocate to one particular bond. Taxation, as we discussed, in a way similar. In debt mutual fund, capital gain taxable as short term at a marginal slab rate. Dividend or IDCW, any which way, taxable in your hand at a marginal slab rate. In a bond, the coupon is taxable at a marginal slab rate, whereas capital gain for a listed bond holding period of more than 1 year is taxable at 12.5%. So assuming you are a taxpayer at the highest slab rate, then direct bond or PMS has a marginal tax efficiency over mutual funds. Liquidity, like we said earlier, if you buy a bond directly when you are selling in the market, it depends on the liquidity of the particular bond or the market level. In the sense, if interest rate has come down, bond price has gone up, you are lucky, it's at a higher price, and vice versa. So all these things are there. Whereas in a mutual fund, there's a professional fund manager. They take care of liquidity and you can simply sell. There is no issue on that. Direct bond PMS ticket size is there. Debt mutual fund, I mean, any ticket size is there. HNI is to low ticket size. There's a concept called laddering. Laddering means so you have certain expenditure buckets, like you do financial planning, 1 year, 3 years, 5 years, 7 years. You can buy bonds of various tenures, like 1 year, 3 years, 5 years, 7 years maturity, so that on the maturity of the bond, you create a natural cash flow which does not depend on any other factor. You can do it through equity also, but equity, if you redeem after 1 year, if the market is lower, your returns would be suboptimal. Then some more aspects I will tell you about the market, overall market aspect. So what we see here is the growth of the outstanding quantum in the market and the relative composition of the market. So towards the bottom, what you see in blue, that is the GSEC. So GSEC, as you see here, approximately 120 lakh crore is the outstanding quantum. That is the biggest chunk. So if you look at the pie, that outstanding thing, this is the biggest government bonds. Then the orange component is SDL, that is state government security or state development loan. That is the biggest component. Then you see some T-bills in gray, which is not as much. Then you see corporate bonds. So broadly, SGS and corporate bonds have a similar outstanding quantum, approximately 60 lakh crore. Both are like half of GSEC. So why is GSEC so high? Every year, the government has a budget deficit, fiscal deficit. And the fiscal deficit is financed largely through issuance of government securities, GSECs. And then we have a little bit of CPs and CDs. CPs are issued by NBFCs and manufacturing corporates. The quantum is not as much, and CDs issued by banks and certain financial institutions. So CPs and CDs are money market instruments. So adding up all this, we have like 275 lakh crore is the outstanding quantum in the debt segment. So this is the pie chart. So GSEC is the biggest pie. T-bills also are issued by the government. Quantum is relatively lower. So STL and corporate bond quantum not exactly same, but kind of similar. And CPs and CDs also are they're relatively smaller. The reason is, you know what, CPs and CDs being lesser maturity, like 1 month, 3 months, 6 months, 6 month, 3 month kind of maturity, they fall due for maturity and the company or the issuer issues again. So the outstanding quantum remains on the smaller side, but they keep on issuing against maturities. So I'm towards the end of my PPT, we'll discuss more. What I'm showing you here is, since we are discussing the outstanding quantum on the pie chart of the market. So what I'm showing you here is, if you look at the dotted curve towards the bottom is outstanding corporate bonds, approximately 60 lakh crore, that is going up. The gray one is outstanding bank loan to industry and services. So banks give loans to individuals, personal loans, like all this home loan, auto loan, personal loan. Banks give loans to industry, to services, and agriculture also to a much lesser extent. So the loans given to industry and services, that also is growing. The orange curve is the total outstanding bank credit, including personal loans. So if you look at it, say 10 years ago, personal loan was the smaller chunk, industry was the bigger chunk. It is the reverse now. Today, personal loan, including home, auto, and all those personal, is the bigger chunk than industry. That has grown. And you see the market cap of NSE. So what is the message here? Apparently, if you look at it, you will think that what is the amount of money corporates have raised through issuance of equities, and what is the amount of money which corporates have raised through issuance of bonds? You will see equity, you will think equity is much higher. And that is the point I want to make here. Through issuance of bonds, corporates have raised approximately 60 lakh crore. Now, if you add this industry or services, that loan component, if you add up the two, you get a certain quantum. Now the market cap, let's say 400 lakh crore is the market cap of NSE. Market cap is computed at the current market price, 10 rupees face value. Price is say 100 rupees, 1000 rupees, MRF is 1,40,000 rupees. So market cap is much higher. As against that, what is the amount of money which the company has actually raised through issuance of equity? It is much lower. There is no defined number. Let us say ballpark number is 20%. So if the company has got, let's say, 20% of the total market cap, amount of money raised to equities is much lower than the apparent number of 400 lakh crore. So if you add issuance of bonds and if you add industry and all that, from the corporate point of view, it is higher capital is raised through loans from banks and issuance of bonds than the amount of money through issuance of equities. So bond is a bigger source of capital than equities. So the PPT is done. I will talk for a little more time, then open for Q&A. Some of the points I'll make verbally. So what are the suitable debt segments? So when we say suitable debt segments, there are two perspectives. One is the maturity and one is the credit rating. So maturity-wise, there are multiple maturities. So the first point is there should be a matching of your horizon and the maturity of the bond or the mutual fund portfolio maturity. Now, at certain points of time, depending on the interest rate view, some brackets look attractive. Sometimes fund managers say belly of the curve. Belly of the curve means approximately 4 or 5 year maturity. That looks better, depending on how the yields have moved up. Or for example, if yield levels have moved up and we are expecting RBI rate cuts, then we say longer maturity is better, because longer maturity, higher duration, that segment will benefit more if rates are cut, and vice versa. If rates move up, longer duration will lose more than shorter duration. So it depends, but as of now, there is no question of RBI rate cut. It's more about RBI rate hikes because inflation would move up from here. So rather, you should try and balance. So in your portfolio, if you have a certain bucket for 1 year, you invest in 1 year bond or 1 year mutual fund products, 1 year portfolio maturity products. 4 year maturity, invest in a 4 year product. 10 year maturity, 10 year horizon, invest in a 10 year product. On credit rating, it depends. Like we said, the scenario is much better earlier. But as per your risk appetite, you invest in AAA bonds or AAA portfolios or AA or single mixed portfolios where you get the yield uptick, you get much better yields. And today, the corporate health scenario is much better than earlier. And lastly, the interest rate view. So interest rate view is that depending on the market expectation of inflation and so many other variables like GDP growth and so many variables, what are central banks expected to do? So as of today, globally, central banks are hiking rates. In the USA, they cut rates significantly from September 24 till date. They have cut rates by 175 basis point, 1.75%. But now the market view has changed about US Fed. Market view earlier was rate cut. Now the market view is rate hike going forward because the inflation will be high because of the Middle East war, crude oil price, and all that. Eurozone, they have already hiked rates, so they may hike rates gradually going forward. Again, same reason, because of war, crude oil price, gas prices are higher. Japan has been normalizing their interest rate for quite some time. It was minus 0.1 earlier. Now it is 1%, so 110 bips they have already hiked. They may hike more going forward. Coming to our scenario, if you look at the rate cut cycle till December last year, RBI cut rates 125 basis point. But from now on, inflation is expected to move up because of various reasons. Because subpar monsoon, IMD predicts 90% precipitation, so 10% shortfall like a monthly average. Then Middle East war, now crude prices are that much easier. So somewhat higher crude oil price, fertilizer price, and all those adverse base effects. So inflation will be higher. And the RBI may do a shallow rate hike cycle. Shallow means approximately 50 basis point, 25 basis point each. We're looking at a shallow rate hike cycle from the RBI going forward. So I will pause here and now discuss with the participants.
Thank you. Thank you so much, Joydeep. I have a set of questions for you from the audience. And my first question, which we got is, so do you feel that the short duration bonds, are they more attractive than long duration bonds in the current interest rate environment?
Not much. So when does that happen? So when is that shorter tenure bonds more attractive than longer tenure bonds? There is something called steepness of the yield curve. So steepness like this. Let us say, if you can see my pen, this is flat and this is steep. So portfolio theories, financial planning theory says that the yield curve should be steep. Steep means for a longer duration, since I'm taking in more risk or more uncertainty, I should be compensated. For the same issue, let's say the government or a same corporate bond, if I'm buying a 7-year bond against a 3-year bond, I'm taking more uncertainty, so the yield should be higher. So the yield curve should be steep. Sometimes the yield curve is flat or sometimes even inverted in certain exceptional situations. So if, as an example, if the corporate bond yield curve is inverted like this, longer tenure giving lower yields, we will say prefer shorter maturity because you are getting a better risk-adjusted returns. Or even if it is flat, we will say that even if you take more uncertainty, you are not being compensated. But today there is a reason, I won't say very high, but there is a reasonable amount of steepness in the market. So in today's market, you rather invest as per your horizon, like in your cash flow. You look at some cash flow after 1 year, some cash flow after 10 years. As per that, those particular maturity bonds or those particular portfolio maturity debt mutual funds, that would be advisable.
Got it. Got it. Yeah. So, okay. Another one which I have is that can our clients invest in bonds, and what benefits do we gain by facilitating these investments? So when the query is, what benefits do we gain? I mean, as we know, the financial planning profession, it's all client centric and so on and so forth. So definitely, I think Joydeep, you have been talking about this, that certain portion of allocation must definitely go to fixed income and all. So yeah, so that's about this. And then there is another question is that what measures should we consider before investing in fixed income securities? Of course, you have spoken about the credit rating. We need to see government ka hai ya public sector hai, kiska hai, and what is the risk and all those things. So would you like to elaborate more on that? What measures should we consider before investing? So he's talking about, proposing these bonds to the clients. So would you like to speak a bit more about on this?
Sure. So I will club your previous question and this question. The benefits we get, allocation, that is already discussed and decided, that is beyond debate now. The debate is between what is the mode of the allocation. In the sense, you want to allocate so much to fixed income, 20%, 30%, 40% of the portfolio you want to allocate to fixed income. The debate is about the mode. Is it you invest in a mutual fund scheme, debt mutual fund scheme? Is it you buy bonds directly, or you give it to a PMS manager? So it is like this. Like, to answer this second question, if you don't have the bandwidth, if you are not a large investor, or if your client is not very large, then you go through a mutual fund, because at the cost of whatever expenses they are charging to the fund, there is a professional team sitting there. They are giving you the facility of low ticket size, and they are giving you the facility of liquidity in the market, which is not very liquid. Okay, equity is improving, but not very liquid. You simply redeem T plus 2, T plus 3, you'll get the money. So you go for the mutual fund. Now, if you're a reasonably large investor, you get the facility of a service either by a PMS if you have 50 lakhs, even if you don't have 50 lakhs. There are so many bond houses in India where they give you service, they do their research. And nowadays we have this thing called OBPP, that is online bond provider platforms. So on their platforms, so let us say there's an OBP who have, let's say 50 bonds on their inventory, which they are showcasing on the website. You can simply go and buy online digital, no issues. Thing there is, it's about your research. But usually what people see is there's a AAA bond offering, say 7.5% yield, and there is a single A bond offering 12% yield. People will jump, 12.5 is higher than 7, so I'll buy this thing. People tend to forget about the risk. So it is about the credit rating. It is about the market perception. If you have the wherewithal for research, good. If you don't have it, you give it to a mutual fund or go with a bond house who have their in-house research. You can talk to them. What is the research you have done? Why are you recommending this bond? Or to put it very simply, the yield level itself is an indicator of this thing. As an example, same bond, let's say double A rating. There are two bonds. Okay, I should not take names, but just for the sake of clarification, let us say I take a name. Same double A rated bond issued by Tata Group company and double A rated bond issued by India, this thing. The Tata bond will have a lower yield because the market perception is better, and some other this thing will have a higher yield because the market perception is weaker. If you look at, let's say, this DHFL default, much before 2019, when the defaulted, the yield on DHFL bond was much higher than HDFC Limited. Now it's a bank. So approximately 75 to 1 percentage point difference was there, which means the market was indicating the risk in DHFL is higher than HDFC Limited. So yield level itself indicates higher risk means higher yield means higher risk. So either you have your own research or go with either a mutual fund or a bond house or an OBPP, as long as you're comfortable with the issuer group, the goodwill of the issuer.
Yeah, correct. I mean, that's quite evident actually. I mean, all these parameters what you have spoken about. So another question which I have is that, for young investors with a long investment horizon, what kind of percentage allocation should be given to fixed income? I mean, what is your recommendation? Is it any fixed kind of allocation, or is it goes with the customer and psyche and risk and all those things? Especially we are talking here about young investors with a long investment horizon.
Yeah, got it. So it is more about the customer because it varies from person to person. So risk appetite and risk-taking ability are different things. In a sense, a young person may be conservative and an old person also may be aggressive. So as a ballpark, in the initial part of your career, since you have a long horizon and you have a risk-taking ability, allocate more to equity. And as you go more towards the consolidation phase, consolidation means just before the deaccumulation retirement phase, you decrease equity and increase fixed income. So I won't your number as such. Maybe initially you have like say 80-ish to equity. As a move towards retirement, it may be like say 50-ish to equity, and in the retirement phase have less than 50% to equity and more towards fixed income for stability. So as per your risk-taking ability and risk-taking appetite.
Okay, correct. And Rutika, if time permits, I have a very quick question. One last question, if you allow, is that people say that
Sure.
that they can see the all these track performances and then in mutual funds and all. So how can we track performances in bond? How can we check the return in bonds, and how to track? Are there any platforms wherein people can track the performance of these bonds and all?
Practically difficult. It is easy to track GSEC performance. So there is a website CCIL, Clearing Corporation of India Limited. So you simply go to cclindia.com and click on GSEC. And during market hours, 9:15 to I think 5-ish or whatever time it is, it will show live yield levels on GSECs. That is easy to track how they are doing. And there are certain indices published by NSE and other organizations which give the performance also, like 10-year GSEC, how much it has given over the last so many years. That is easy. Corporate bond is difficult. if you do a Google search will take you to their particular website, NSE or BSE. Bonds are listed. It trades on NSE or BSE, and you can see those levels. Why I'm saying it is practically difficult is any particular trade that has taken place since the market is not so liquid. How desperate the buyer was, how desperate the seller was. All those equations, less liquidity, all those issues come. So it may not be a proper indication of the thing in the market. So if you want to track the yield levels of corporate bonds, it is practically difficult. Fund managers, dealers know it because they're professionals, but for laymen, it is practically difficult. You can track GSECs for a broad idea, like yields moving up, yields coming down, like 1 2-year GSEC, 3-year, 5-year GSEC, 10-year GSEC going up and coming down, that you can track through the CCIL website.
Okay, understood. So basically what you are saying is maybe it's difficult for corporate bonds, but for others, there are multiple websites, especially in what you have presented is CCIL and all. Yeah.
Not multiple. All these T-bills and all, SGS, T-bill, GSEC, it is CCL, Clearing Corporation of India Limited.
Only CCIL. Okay.
Yes.
Okay. So that's good then. Easy for people to keep a track.
Yes.
Okay. Thank you so much, Joydeep. This is all we have for today. I mean, I can still see some questions, but because of time constraints, I will not be able to take them. And probably we'll write to you, Joydeep. Any other questions are there, and we can request your time for those. Thank you once again from the audience side, and thank you, audience, for being such a wonderful for this learning session, Joydeep. And let's hope to catch up soon again with some more interesting insights on fixed income and other similar subject matters with you, Joydeep. Thank you so much. Bye-bye, everyone.
Thank you.